to Small Business Finance 101, and today is all about understanding that what you don't know can very much hurt you. And what we're going to be jumping in today is understanding some of the basics of Small Business Finance 101 and the things that can hurt you and some of the big decisions that you can make that are very, very wrong. In fact, of 800 business managers and CEOs surveyed, they said that the biggest mistake in business is making emotional decisions. And leveraging, understanding, knowing financial models and financial tools that are out there, we can avoid making these emotional decisions and make our decisions much more logical. So what we're going to be covering today is basically the starting up stage. This is where you should be using the break-even tool. Then the getting funded stage. This is learning how to speak to your banker and understanding the financial ratios that they're using. And then finally, in the growing stage, this is when you have to make a lot of different decisions going one way versus another. Pricing models, understanding whether or not to invest in equipment. And all of these various decisions can actually be looked at very objectively using financial tools. And we're going to walk through these 5 financial tools really, really quickly today. So the first one is break even. And basically how this works is we need to understand how much money we're making each sale and how many sales then it would take until we start making money above and beyond whatever our original startup costs or our overhead costs are. So the break even point is really when do you start keeping money in your own pocket. And the way we do this is a 2-step process. Step 1 is figure out how much contribution margin or how much profit we're making for each sale. And the way that we do this is we simply look at the price of each sale and we take away the direct attributable costs to each sale. So let's look at some examples of how we could do this. First, we have a hairdresser. Let's say the price of a haircut is $30. And the hairdresser uses, I don't know, gel, mousse, some special shampoo and conditioner, and any other styling products, or even hair dye. Okay, great. That all costs only $5. So their contribution margin for that service is $25. Every time they cut someone's hair, on average, they're making $25. A restaurant, let's say the average bill for a meal is $100. And the cost, let's say, the bottle of beer, the Coke, the vegetables, the meat, whatever it is, costs about $30 from the grocery store. So that means that each time someone pays a bill for the meal, it's about $70 that the restaurant's making. That's their contribution margin. How about even for a towel, so products rather than services? So the towel can be sold for $20 and it was purchased, and including maybe even the transportation costs, were $4 per towel. So for each towel, $16 is kept in the owner's pocket. And then computer. Let's say it's $300 for a wholesale price of a computer, so that's what we're selling it for. And then the parts and the assembly all cost about $60, so we're making about $240 per computer, something to this effect. So now that we know our contribution margin for each sale, we're able to figure out our break-even units. And we take the entire fixed costs. These could be our startup costs, our rent, our overhead, so labor, our management costs, our car, our house, whatever it is that we look at as the cost that we are going to incur even if we don't make a single sale. Those are our fixed costs. We take those, divide by the contribution margin, which we did in step 1, and out pops our break-even units, or our break-even number. The break-even number is so important because we can use this to compare ourselves to our competition, to compare ourselves to other industries. We could even figure out if a marketing campaign makes sense. So should we be investing this marketing dollars in this advertising? Because then our break-even units back would be X amount. So we can use break-even for that. Does it make sense to enter a new market, or should we launch a new product or service? All of these times we could use the break-even tool to assess whether or not to do it. So it's no longer emotional, it's now extremely logical. We know exactly how many units we'd have to sell to break even. So The next thing is, now that we know that it breaks even and we decide to start up or launch a new product or launch a new service or go into a new market, now we're going to have to potentially speak to a banker and get a line of credit or a loan. And really what we need to understand is that a banker is looking for 4 very distinct things. Number one, they want to make sure that your business idea is great. Your break even is part of that. That's really going to help. Even understanding whether or not it's marketable. Will people actually buy this? Is it needed out there? The second thing they're looking for is how much money you put in. That's called equity. So how much money did you put into the business yourself? If you didn't put money into the business, why should they, is what they're asking themselves. Next is security. So if they give you $10,000, what happens if your business doesn't work? How are you going to pay them back? That's the next question. So how are you going to guarantee to pay them back? And the last question they're asking is, do you have good credit in general? So that's where they do the credit check. And even whether or not they like you, how you present yourself, whether or not you have confidence, if you're believable. All of these pieces come together to help a banker or your bank advisor determine whether or not to lend money to you. The next thing that they're going to be doing is looking at your financials. So after we have those 1, 2, 3, 4 checks, now we look at specifics of how much we could lend and also understanding whether or not you're still a good candidate to lend money to. The first thing is the quick ratio. And I mean, we could also do other ones in here. We could do the current assets over the current liabilities. But the quick ratios is a really good gauge for ourselves as well. And this is where we take our total cash that we have divided by our current liabilities. And current liabilities are any debts, loans, bank loans, lines of credit that we have to pay back in the next year. So it might be our mortgage payments for this year would be our current liability. But the entire mortgage definitely isn't. When we do this, we want to make sure that, of course, this is going to be above a 1. So cash divided by our current liabilities. Because if we don't have enough cash on hand to be paying our current liabilities, that could be a problem. Typically, we do current assets over current liabilities. But even better is often cash, because part of current assets is inventory, and sometimes that's not a great figure to be using, especially if inventory, you're having a hard time selling it at that point in time. Then it's not as liquid. It's hard to turn that into cash. So knowing that your cash is greater than your current liabilities is great. Actually, the running number on this is 0.5. We say 1, but the 1 is a little high for sure. 0.5 is really what people are looking at. Interest coverage. So can you actually pay the interest? And this is going to be more important for organizations, companies that have a lot of equipment. So manufacturing companies for sure, is they're more concerned on being able to pay your interest this year and next year and ongoing, because that's something that you probably haven't bought the equipment with your own money. It's going to be making sure that over time you're paying for it. So what they're looking for is what's your total income minus any interest that you have to be paying, of course, and your taxes. So the income that you're keeping, and then we want to divide that by your interest payments to see how many times over you're making money versus how much interest that you pay. I mean, if it's 1-to-1, you're basically working for the bank. That's not okay. You want to be making sure that you're probably upwards of 10, 15, sometimes even higher is what you're looking for. Next is debt equity ratio. And this one's pretty straightforward. It's going to be how much debt's in your business, so your liabilities, divided by your equity. So how much do you own as the owner of the company, or your shareholders have in terms of monetary value within the business. And typically a bank is looking that this couldn't go more than 1. So the whole idea is that typically you should have more equity than liabilities in your business. However, that may not always be true depending on how much mortgages that you might have, or depending on how much of a loan you have in terms of buying equipment. And basically if your equipment maintains value, then that's the security, and the bank would be willing to give you more debt for that. However, Many large businesses are looking at this being basically 50-50 in terms of liabilities and equity being about the same. On the flip side, if you're a growing business and you're only growing from your equity, it's kind of interesting. You've actually slowed your potential to grow. So leveraging debt and leveraging basically other people's money is a good way to increase your growth rate. But at the same time, there's going to be the risk involved in that. So your liabilities versus equity, this is a big decision to be made in your business. And then the final one here is your retention rate. So how much of your income that you make as a business do you intend to continue to put back into your business? And these questions are things that your banker would actually like to run, like to know, but they're also great things for you to know as a business owner, because there might be immediate red flags for yourself of things that aren't going or are going in the right direction. So, quick ratio, do we have cash on hand? Are we able to pay our current liabilities? Maybe we have too much cash on hand. That's another thing to be looking out for. Interest coverage, is this higher or lower than last year? Are we on track? Have we exposed ourselves to unnecessary risk? Should we be limiting how much more debt we incur? Debt equity ratio, this one basically is, hey, do we have an opportunity to leverage other people's money? Could we have a higher growth rate? Or should we actually be paring down on that because maybe the bank is going to stop us because we've gone more debt than equity in our business? And then finally, retention rate, this being a very good way to grow your business. So really, speaking to your banker, there's many other uses for this. You could have the financials and the financial ratios for your own strategic planning sessions. You could compare your own business to industry norms to see where you fall. It could also be the red flags, so risk mitigation, and also then, of course, realizing where you have opportunity for growth. And that was the retention rate and the debt equity one. So now that we have our money and now that we understand our break even, let's jump into the last one, choosing between options and making sure it's no longer emotional but a lot more logical. And we're going to be looking at 3 different tools here. Number 1, weighted averages. Number 2, decision trees. And number 3, net present value. Number 1, weighted averages. This is great for choosing between products or services, what market to penetrate, what target market to go after, what growth strategy is best, what pricing model, what organization to partner with, who to work with as a supplier, and many, many more. So choosing between options, leveraging weighted averages is a great way to go. All you have to do is outline what your options are, and then what criteria you're going to rate them against, and then assign each criteria a weight. So if criteria 1 is more important than 2 and 3, we rank it as 10 versus 5 versus 5. Then we rank out of whatever the criteria is out of, whether or not option 1 meets that criteria or not. Then we add up, we total at the end, and we're very easily able to identify what are the best options. So out of these 4 options, the best options look like 4 at 15 and 1 at 14. Weighted averages, very useful logical tool. So the next one is decision trees. This one's great for projecting sales forecasts, maybe entering a new marketplace, new product development, and risk mitigation. So basically making a decision that could mitigate your risk. So the example here is snow shoveling. We have no control whether or not there's bad weather or good weather. So is there going to be a lot of snow or a little bit of snow? We do have control of a decision. Are we going to use fixed pricing? So that would be that for the entire season, we only charge $300. And we'll plow your driveway every single time it snows for $300. And even if there's a ton of snow, it doesn't matter, we're there. Or variable. We're just going to charge you $50 every time it snows. So if there's 10 major snowstorms, that's going to be $500. But if there's only 4 major snowstorms all year, then it's only $200 that we make. Okay, so now that we've kind of identified what's going to happen if it's fixed price or variable prices that we have, and we don't know if it's going to be bad weather or good weather, but we can figure out what our probable income would be based on using a decision tree. if it's 50% chance of bad weather and 50% chance of good weather, and these are our various outcomes that could happen, we can multiply the percentage chance of something happening by the outcome amount, and we can see that this is 125, and we do this for all the scenarios. Then what we can see is we can compare what we have control over. We have control over making this either a fixed price or a variable price. So our fixed price, if we add this outcome plus this outcome, would be $275. If we choose fixed pricing, we're most likely going to have $275. What about variable? Well, $250 plus 100. We're most likely, if we do variable pricing, to make $350. However, if you do this, you have to realize that the low amount that you could end up making is the $200. But this is what's probable based on your two pricing models based on the probability of bad weather. So the decision tree shows you the probable outcome. And the third tool that we're going to cover today is the net present value. And this is something that we call it NPV. A lot of people love this one. This is great to choose if you should buy equipment or buy property or buy technology, invest in an expansion, or even to hire someone. It could be any of these things. It's any time that you're outlaying cash for future income. So let's say in year one we outlay $5,000 and we expect to get an instant $3,000 back. So we know that we are going to have a difference of $2,000 and we've actually still lost $2,000 in the first year. That's okay, because the next year it only takes $500 to maintain whatever we've done, be it equipment or technology, and our cash inflow benefit is going to be higher, or sorry, the same at $3,000. So now we actually have a difference of $2,500. The big thing that we have with net present value is we understand that money today is worth more in our hand than money tomorrow. Because if we had money today, we could invest in the stock market, bonds, or some other investment, maybe in our business, and that money would make money. So it's worth more today than tomorrow because we have to factor in that interest rate. So what we've done here is we take that difference and we figure out what that would be worth. So $2,500 next year is worth $2,232 to us today. So we backtrack that. And we do that for every year. And we can see that already in year one, the $2,200 is worth more than the negative that we have. So this is a good investment to pursue. So what we covered is the break-even tool, different financial ratios to be exploring, and then we looked at the weighted average decision-making tree and net present value. And now we have 5 tools, and there are many more, but those are some of the greatest ones, 5 tools to help us avoid the biggest mistake, being an emotional decision. Because with finance, what you don't know can in fact hurt you. Brought to you by the Small Business Solver team.